Bull versus bear segment. Tata Motors in focus. Jaguar Land Rover has flagged a weak FY26. JLR is two-thirds of Tata Motors' top line, and the recent US-UK trade deal offers hope of tariff relief and potential revival. But Puneet's here to give us a perspective both of the bull case as well as the bear case. Puneet.
Well, thanks so much for that. We'll be focusing on the Jaguar and Land Rover division because we've spoken a bit about the company as well as the domestic side of the business last week. So essentially, that's one of the first bear cases. They're expecting a revenue decline in this fiscal year, expecting it to go to roughly about 28 billion pounds versus 29 what they did last year, and that's largely because of what they mentioned, essentially because of tariff impact as well as geopolitical crisis. But those is one of our bear cases, and because of that, the company's revenue is expected to fall. On the other side, they have mentioned that the recent US-UK FTA will help the company, at least in terms of a majority of its manufacturing, because it's in UK, that will help the company impact and get less impacted because of tariffs. That's one of the first bull cases as well. When you look at the other aspect, with the revenue decline, they're also seeing a EBIT margin decline as well. 5 to 7% is what they're expecting in FY26. For context, in the last fiscal year, they did about 8.5% EBIT margin. So it will be a steep downtake, almost 250 to 300 basis point impact on EBIT in FY26 was what the company is estimating. They have mentioned though, and this is a new info that is coming after Q4 earnings, a 1.4 billion pound program of savings for the next few years. At least in FY26, it will be the first full year. That could help, have some positive impact on the margins. But currently, their outlook looks very weak, at least in terms of EBIT margin profile. Finally, in terms of what the valuation are as well as the guidance, is guiding for free cash flow to be zero in this fiscal year from the JLR division. Last year, they did 1.5 billion pounds from it. And this has been a continuous trend with the company. Between 2019 to 2023, the company did zero free cash flow. 2024 was the first year where they did some, but meaningful of that came in 2025. And again, this is expected to be just zero in FY26, will hamper valuations as well. And that's one of the key reasons why JLR is between the, when you do the SOTV valuation, is trading at roughly 2 to 2.5 times EV/EBITDA versus historical valuation of 4 times when the financials were also not in the right place. So definitely the market is reacting to that aspect. Finally, in terms of consensus, we've seen largely being maintained in this particular time frame. Ratings haven't changed much. The target prices have been cut, and that's impacted the return potential to 9.4%. But definitely a tough year expected for JLR going into FY26.
I'd also borrow, Puneet, and you talked about some of those notes, what Morgan Stanley is saying. They're also not as negative on JLR and Tata Motors as some of the others, and let's get that to G. Chokalingam also. They're equal weight on Tata Motors, and they say that the worst is over. There is a clear focus on improving free cash flow and improving the EBITDA. Would you have that faith, G. Chokalingam, when it comes to Tata Motors right now?
I firmly believe that worst is not yet over.
Not yet over. Okay.
Yeah, it is still a long way to go to see the worst getting bottoming out for Tata Motors, because as your colleague has rightly pointed out, the issues related to JLR. Now, on the domestic front, if you look at the passenger vehicle segment, it has lost out to competitors like M&M. M&M still growing SUV sales year on year in double digit, whereas Tata Motors has shown 11% degrowth in May month. And if you come to the CV segment as well, there is a significant degrowth, 5%. So when you have all three major segments pain points, and there are no optimistic view on passenger vehicle or commercial vehicle industry as a whole in the country, I don't think one can confidently say that the worst is over for Tata Motors.
I was just pulling out, in fact, the data for what the average analyst is on the street is seeing in terms of upside on Tata Motors. It's a 10% upside that they see from here. So 741 being the average target price. And we have 17 buy calls, 12 holds and 6 sells. So it's even Steven. Buy versus hold sell 1:1.
So maybe if you want to look at a longer term bet, Tata Motors could definitely be an option. Kush, how are you feeling about Tata Motors amongst all of its peers?
So just to Harsh's point, Harsh, the last 2 months high on Tata Motors has been 742 and 744. So in that case, the analysts have been right, but it's a retrace from those levels. Now, what's happening here is that Tata Motors has a decade-long support at 600. This time around, also it did slip briefly below that, but we've seen a rebound from those levels. So, Tamanna, from a risk-reward perspective, Tata Motors seems a fairly good bet. The news flow is rather mixed, every now and then. So the momentum indicators aren't really pointing, a sharp north. But otherwise, from a risk reward perspective, 12 to 18 months kind of a time horizon, so close to a decade long support zone, I think, if you have, you should continue to hold. If not, you could park, a small amount to it and continue to hold this one. Once this 745, 750 resistance zone is taken out, I think you could see further upsides on Tata Motors, although it could just be gradual and not a V-shape kind of an up.
Okay, so Tata Motors next, and Maruti also